We are starting today with a new topic, capital gains. Income under the head capital gains. As we know that there are 5 heads of income: salary, house property, PGBP, capital gain and other sources. This is my 4th head of income, capital gains. Though I have covered with you only first 2 heads, salary and house property, PGBP I will discuss with you later on after discussing with you the topic of capital gains. Now in this capital gains, what normally we tax? In this, there must be a capital asset. This is one thing, that there will be a capital asset. When you transfer that capital asset, when you sell that capital asset, then you have to compute your income under the head capital gains. Something might be a business asset for me, and the same business asset might be a capital asset for other person. Like jewelry. For a jeweler, sale and purchase of jewelry is his or her business income. But for a person like me, who is not a jeweler, selling jewelry is not my business, it is my capital asset. So I will compute the income from sale of this jewelry under the head capital gain, but the same income a jeweler will compute under the head PGBP. So this is the main difference. Any asset might be a business asset for one person. The same asset might become capital asset, or you can say non-business asset for another person. I have given you the example of jewelry. Selling laptops by a person who is the dealer in laptop selling is his or her business income, but selling laptops 2, 3, 4, 5, 6, 10 laptops, for example, by any other person who normally doesn't deal with laptop sale and purchase becomes capital gain for that person. So when you sell capital asset, when you transfer the capital asset, you have to compute your income under the head capital gains. Every chapter has its foundation. Like salaries foundation lies in section 15. Until and unless income is taxable under section 15, there is no need to read remaining sections of the topic salary. Similarly, in house property, until and unless you satisfy the conditions of section 22, you will not read other sections of house property. Same is the case in capital gain. Until and unless you satisfy the conditions of section 45, there is no need to read remaining sections of capital gain. First section of each and every head explains the foundation. The first section of each and every head tells you whether any income lies under that head or not. If the income lies under that head, only then you will proceed to discuss the remaining sections. Otherwise, there is no need to discuss the remaining sections of that head. So salaries, founding section, charging section or basis of charge, chargeability section, whatever you say, is section 15. For house property, the foundation lies in section 22. For capital gain, the foundation lies in section 45. So before discussing capital gain, let me show you the act from the website of the tax department, incometaxindia.gov.in. I hope now you easily know how to directly go to the website incometaxindia.gov.in and income tax. So this is Income Tax Act as amended by Finance Act 21 chapter wise. And I told you earlier also, chapter 4 is the chapter of the Income Tax Act which is having all the 5 heads. Computation of total income. Click it and I will directly go to section 45. Capital gain. This is section 45 capital gain. As you see, 45. Above 45, it was 44 double D. This is the last section of PGBP. My capital gain starts from 45 and it goes on till 6, 47, 47A, 48, 49, so many sections. 51, 2, 3, 54, 54A, 54C, 54D, 54E, 54EA, EB. So in fact, even the website is having some problem. As you can see, one section 54B is not at all given on the website. So that is why so many times you have to trust yourself, your own knowledge, your own experience. Like if you see on the website, it is 54A and after this 54C, but in reality, section 54B also exists, 54B, but that is missing from the website. So there might be some problem. Anyhow, these are so many sections. So whenever if you apply the provisions, you don't deal with only one authentic source. You so many times see other sources. That is why I say that you have to self-study and read from the original sources. And so many times, even these original sources must be read carefully. Like suppose if some person doesn't know that there is a section like 54B related to transfer of uh, land used for agriculture purpose, that person will never come to know about 54B because somewhere between here 54A and 54AC, here 54A and AC, 54B is also there in real life, but that I don't know why it is not available. It is the problem of the website. 100% it is the problem of the website. Otherwise, there is a section 54B lies there. Anyhow, so it goes on. Capital gain starts from 45 and it goes on till 55A. Till 55A it goes on. Starting from 45 till 55A, the topic capital gain goes on. This is one thing which I wanted to tell you. Another thing now, as I told you that every first section is the charging section. So I should start capital gain from section 45. This is the starting point. Let us click this 45. If you see carefully, I hope the screen is visible, act is visible. If you see, and font size is also comfortable, I think. If you see section 45, there are so many subsections. 45.1, 45.1A, and 45.1B, 45.2, 45.2A, 45.3, 45.4, so many subsections of 45. 45.5, 45.5A, 45.6, so 45. Every subsection tells you a different story of capital gain. When you have to compute capital gain, every subsection gives you different way of calculation and different type of calculation of capital gain. But in our course, we have to do only three subsections: 45.1, 45.1A and 45B. All other subsections are not relevant for our course. This is first thing. So I'm starting discussing with you these subsections. 45 subsection 1 is the main section which deals with calculation or which deals with computation of income under the head capital gains. Not the calculation exactly, but founding section, charging section, 45.1. All other are special. 45 1A, 1B, 2, etc. These all are special subsections. They also tell you capital gain concept, but 99% capital gain cases will be covered in section 45.1. Even in real life, 45.1 is the main section of capital gain. All other subsections of 45 are special sections which deals with you, which shows you special calculations. So I'm starting reading section 45 subsection 1 for you. See this one by word by word. Any profits or gains arising from the transfer of a capital asset, as we can see this word, these two words, capital asset. This word is relevant. And what another thing relevant which you can see? Transfer. So in this line, two these technical points have come out that there must be a capital asset and it is transferred. Now affected in the previous year shall. So if you continue this word, any profits or gains affected in the previous year shall, save as otherwise provided in sections 54, 54B, D, E, EA, EB, F, G, H. Now you can see here, you can see 54B. Here you can see 54B, but when I was showing you those sequence, 54B was missing. So in reality, 54B exists. In section, so let us click this 54B. When we click this 54B, then it is showing the section, but when we were checking this in the sequence of 54, then this section is missing. So there must be some gap here. The people or the persons who are preparing this sequence, they might have forgot to write 54B here. Anyhow, come back to the main point. Save as otherwise provided in sections 54B, D, 54, E, EA, EB, F, G, and H are those sections which gives some exemptions. Like if my capital gain has come out to be 7 crore rupees, might be these sections will exempt 1 crore, might be. Every section is having own conditions also. So what this 45 subsection 1 wants to convey, that when you transfer the capital asset, do remember that it has passed the test of, it has passed the exams of section 54, 54B, D, E, EA, EB, F, G, and that means 45.1 is inferior than these sections. So first you must be having the knowledge of these sections 54, 54B, etc. If you have the knowledge of these sections, you apply those provisions, then you apply the provisions of 45.1. This is what the point is. This profit and gains be chargeable to income tax under the head capital gains. Yes, that's it. This is what my capital gain conditions are. So whenever any capital asset is transferred during the previous year and it has passed the test of these sections, then whatever is the figure that has to be taxed under the head capital gains. And shall be deemed to be the income of the previous year in which the transfer took place. And first of all, it has to be taxable under capital gain, but in which year it has to be taxed under capital gain? In the year in which you transfer the asset. Let me simplify this section for you now. So let me share with you my screen and let me simplify it for you. Now see this. This is my fourth head of income, and now I'm making in this heading first point. Basis of charge. What is the charging section, or what is the chargeability? There are many subsections of section 45. Broadly, the entire chargeability is in section 45. Within 45, there are so many subsections. I'm not discussing all those. Within 45, there are so many subsections. 45 1, 1A, 1B, 2, etc. etc. I'm not discussing all those. Other than one, all are special. And this one is normal. And if I say normal, then most of the calculations will be as per 45.1. Or most of the calculation is as per 45.1. These are special. But in our course, we have to do 1, 1A and 1B. So I am starting with section 45.1. What are the conditions of 45.1? First, there is a capital asset. This is one thing. So the next question arises, what do you mean by capital asset? That I will discuss with you after some time. But there is a capital asset which is transferred during the year. Now, such profit or gains, what are profit or gains, is there because of transferring this asset. That profit or gain, the profits or gains, is not exempt. Since you do not know the detail of those sections 54, 54B, D, etc. You must know that for the time being, you must know that all these sections talks about exemptions from capital gain. The profits or gains is not exempt under section 54, 54B, 54D, 54 EC, etc. etc. And if the above conditions are satisfied, if the above conditions are satisfied, then what happens? Income has to be computed. Income has to be computed under the head capital gain. This is first thing. Income has to be computed under the head. Income under the head capital gain is required. And another thing was, and it will be computed in which year? In the year. I'm not writing complete sentence, okay? This is only the relevant points. In the year in which transfer took place. Now, for example, on 7th December 2018, I transferred jewelry to someone, but he has not given me the amount on 7th December 18. On 7th August 2020, I received the amount. I received the amount. Now, do remember, it is a little bit confusing example. Asset was transferred in which previous year? 18-19. But amount is received in which previous year? 2021. Now, can you tell me in which year I will compute the income under the capital gain? 1920 or 2021? Hurry up.
So 1819.
Yes. So in 1819, the year in which I have transferred the jewelry, as per 45(1), in that year I will compute the income under the capital gain and I will pay the tax. I cannot say that since I have not received the amount, I will not pay the tax. No. Act says the year in which you have transferred the amount, transferred the capital asset. If you are covered under 45(1), we will not wait for you till you receive the amount. If you have transferred, you need to pay the tax. This is first point of 45(1). In almost 99% cases, even in real life, will be covered under 45(1). Then let me discuss with you special sections. 45(1)(a). This is special. All other subsections are special. 45 subsection 1 is normal. All remaining are special, but we have to cover only two special subsections, 45(1)(a) and 45(1)(b). Let me discuss. This is 45(1)(a). Now you please read it and then you try to explain me this. Let me see whether you can explain this from the act. This much is required to be read in 45(1)(a). Please read it and then anyone, if you can try to explain me or if you can try to simplify this for me or for yourself. Read it and try to simplify.
So 45(1)(a) says that even regardless of whatever subsection 1 says, that even if no transfer of any sort of asset has taken place or capital asset has taken place, if any person or assessee has any time during the previous year received money because of insurance on account of damage because of, say, flood or any sort of natural disasters or even fire, then even that income, if they amount to a profit or a gain, are chargeable to tax under capital gain in income tax
In which year?
in the year the money is received.
So that means there is a difference in 45(1) and 1(a). In 45(1), I was taxing the amount or I was computing the amount of income under that capital gain in the year in which transfer took place. But in 45(1)(a), I'm not computing the amount in the year in which asset is destroyed. I am now computing the amount in which the amount is received. So this point you can also notice. So what you have said is correct. What technically section 45(1)(a) says, notwithstanding anything contained in subsection 1, it does not matter what subsection 1 says. Ignore subsection 1. What I say is final. What I means 1(a) says is final. Where any person receives, so the word receives, at any time during any previous year, any money. Now it does not talk about only cash or directly bank account transfer from the insurance company. It talks about what? Other assets. Might be insurance company is giving me, if my car is destroyed in riots, might be the insurance company has given me another car. Still that is taxable. So not only cash. You must remember that Act uses the language other assets. Under an insurance from an insurer on account of damage to or destruction of any capital asset. Here also, one thing is sure, which you have not explained, asset must be a capital asset. So what has been destroyed must be a capital asset. This is sure. Even in 45.1, it was a capital asset. In 45.1a also, it must be a capital asset as a result of, because of these reasons which are beyond my control or beyond the control of a human being. Flood, typhoon, hurricane, cyclone, riot, accidental fire, war, then any profit or gain arising from receipt of such money or other assets shall be chargeable to tax under that capital gains, but it will be deemed to be the income not only of not in the year in which the capital asset was destroyed, but in the year in which the money or other asset was received. Now after this you are not supposed to read right now because that tells you a different point. It tells you how to compute the capital gain or what things are required to compute capital gain in such circumstances, but that I am not discussing right now. Right now my purpose is to discuss with you founding sections, charging sections. So let me simplify this for you. Special. Other than 45 subsection, all are special. 45.1 again, conditions. Capital asset here also, capital asset is destroyed. During the previous year. Of course, now these words during the previous year are not supposed to be mentioned because of course you know the date of their damage. So by default it will be there in every provision. Otherwise logically there is no need to learn it. By default you must write. The damage is due to what? Due to flood, war, riots, etc. You have received what? Amount or other asset. Amount or other assets have been or other asset has been amount or other asset has been received from the insurance company if above conditions are satisfied. Then what happens? Income is to be computed under the head capital gains. And what? It will be computed in the year in which amount is received. Not the year in which asset is destroyed, in the year in which the amount or other asset is received. This is what 45.1a. Next point. Now let me again share 45.1b. 45.1b. Now this is in italics, and if you click this 21, which is the number, and it gives you the detail. Italic means it is a new section. If you see this, now what has emerged in the bottom, inserted ins dot means inserted by the Act number 13 of 2021 with effect from 1/4/2021. 1/4/2021 means assessment year 21-22. So it is the first time, this is the first time when you will be studying or everyone will be studying this subsection 45(1)(b). Till last year it was not there. Now before reading this section for you, let me tell you that till last year what was happening, when I have taken any insurance policy, ULIP plans. Now first let me, before discussing this section, let me tell you that what was happening till last year. What was happening till last year, you must know. So this discussion is required to understand 45(1)(b). Before making you understand this section, you must remember that what happens when we take life insurance. There are two types of life insurance. For your level, this is what I am telling you. Term insurance, which are known as term plans or term insurance, and investment based insurance. What happens in term insurance? Anyone who can tell me what happens in term insurance? These are good plans, we should purchase it. People must be having this term insurance. Anyone who can tell me what happens in term insurance?
So till certain age, you pay small premiums, and if any unfortunate event happens, so the insurance company will pay you a lump sum, like your family, to a lump sum amount, which is good enough, basically,
Which is?
which is good enough as compared to the premium we pay.
Yeah, but you should not say that till up to certain age. It's my choice. I can purchase this plan even at 90 years of age. What is the problem? The
Yes,
premium will be high.
usually it's not recommended, but you can purchase it up till 99 or 100 years old.
Yeah, so it's my choice. Anytime I can purchase it if policy plan of the company allows me. So one thing is main that if today, for example, for the year 2021, if I have purchased this insurance, term insurance, I paid a premium of, let's say, 20,000 rupees. I might get the coverage of 50 lakh rupees. By paying yearly 20,000 rupees, for 1 year I am securing the life or something for my family. If any unfortunate incidents happens, then company will give me my family 50 lakh rupees. This is what term insurance is. But after the expiry of this 1 year, suppose it was 2021, and if it says that my coverage was from 1st April 2020 till 31st March 21, on 1st April what happens? Do you have this plan? No. On 1st April 21, then I am unsecured. I am not insured. I have to purchase and pay the premium again. And this 20,000 on this date I should forget now. I should not expect that I will get any amount on or after 1st April 21 from this premium amount. No. You paid the premium, company secured your life, company provided surety to you for 1 year. After that 1 year time, now company will forgo you, forgo you, company will leave you, you should leave also the company. If you want to purchase and secure another year, then pay separate premium, but 20,000 becomes redundant now on 1st April 2021. These are term insurance. Now people don't prefer it, they should, but what they think that after 1 year they will not get anything from 20,000. They forget that for 1 year they are living in a peace of mind that if something happens, 50 lakh will be given to the family members. A good amount which can take care of the remaining members. Till the person is alive, the person will take care of the family. But in case the person is not there, unfortunately, at least family gets some handsome amount to live life. What are investment based life insurance? For example, for 2021, I have paid a premium of 20,000. Company will always also give me insurance, but not of 50 lakh. Then my insurance would be maybe 6 lakh rupees, 7 lakh rupees. That's it. Company will not give me the insurance of 50 lakh, because from this 20,000, some amount around 60 to 70% will go in investment, which I can claim even after the expiry of 1 year. Like if this policy period was 1st April 2020 till 31st March 21, during this period, I got the coverage of 6 lakh, and after this 31st March, that means from 1st April 2021 also, I will not say that entire amount 20,000 has become redundant. No. For example, 14,000 has been reinvested. For example, it depends upon the company's policies. When you purchase it, you should read the terms and condition. Maybe some companies invest 80%, some companies invest 70% of the premium. This amount will go to the share market and they will invest, the company will invest in the stock market. And there is not only one human being who has paid the premium of 20,000, there may be crores of people who are there. So in stock market, shares will be purchased, and since the shares cannot be divided amongst these 1 crore people, they divide the share on the basis of some units. For example, if it is 1 share and suppose there are 1 crore people, you divide it by 1 crore, so you get on an average number of units. So total shares will be divided by number of these people who have invested it. So every human being will get some units. Every person will get some units. And that is why so many times we have the plans, unit linked insurance plans, where if you take the insurance, some amount will go to the share market, it will be invested in share market, and you will be allotted units. Because if you want to purchase directly the shares, you can directly purchase the shares. Why do you need the help of any other intermediary who will purchase shares for you? These unit linked insurance plans helps in minimizing the risk, because the shares will be invested in different companies, different good companies. So if one company falls down, at least my investment is safe in other companies. So it is known as diversified portfolio, when your investment is in different types of securities. These are unit linked insurance plans where you get insurance as well as also for investment you get units. Now might be after some time I want to sell it. In term insurance, the moment I pay 20,000 and got 1 year insurance, after this I don't have anything to sell, it lapsed. But these units, suppose for 14,000 I have invested in this company invested in stock market, I got some units, and when I sell those units, might be I have received 40,000, might be. So the units which were purchased for only 14 might be have been sold for 40,000. Technically there is a gain, less cost. Now this is on a rough example only, it is not the exact calculation, just to make you understand. Technically there is a gain 26. Question arises, is it taxable or not? Till 31st March 21 it was tax free, it was not taxed because of some provisions of section 10 clause 10d. I'm not saying that fully it till 31st March 21 also it was coming with some conditions. There is a section 10 clause 10b, where depending upon different conditions the amount was tax free. What government has noticed that now a normal middle class person, how much maximum do you think that person will save per year for life insurance? Can you have any idea that most of the people will pay the premium of Maximum how much per year? Any idea? What do you expect that how much per year insurance amount is considered as good amount, as a premium? How much maximum you think people are paying? Okay, if no idea, ignore it. But if someone is paying per year 2,50,000 premium, it is considered as very good amount. It is considered as the amount where the person who is paying is a rich person. Person who is paying a premium of around 1,50,000 is a person who is having who is from high middle income class. Normal middle income class person doesn't save this amount towards insurance premium only. They can save towards PPF, etc., etc. But only for life insurance policies, paying a premium per year of 2,50,000 is considered as a handsome amount. Till last year, when these units were encashed, till last year also, people were paying the premium. They were purchasing the units through this insurance company or through mutual funds or whatever in the stock market. When they were selling those, they must be earning some income. It was almost tax free, of course, but we need to check even till last year provisions of section 10 clause 10b that I'm not discussing with you for the timing. But now, from now onwards, from 1st April 2021, now what is happening? This I will tell you in section 45(1)(b). Is the discussion a little bit clear? That before making you understand 45(1)(b), I wanted to give you a little bit idea about these ULIP plans. Is it clear? Please raise your hands. In case in doubt, you can ask. If the discussion a little bit clear, that yes, how this life insurance company amount is routed, what are these ULIP in unit linked insurance plans, etc. Now let me share with you the website of tax department, or you can say let us discuss, or let me show you section 45(1)(b), which is newly introduced section, and let us see what it says. It is a little bit technical, but let me show you the language. Notwithstanding anything contained in subsection 1, here also it does not matter what subsection 1 says. What section 45(1)(b) says is final. Where any person receives, here also the word received is relevant, receives at any time during any previous year any amount under a unit linked insurance policy. Same example which I am discussing. When you redeem your insurance policy, when the policy is matured, whenever you receive the amount from your unit linked insurance policy, to which exemption under clause 10 of section 10 does not apply. Now that is why I gave you the reference in the example also, that till 31st March 21 also, the amount received was tax free under section 10(10)(d), which came with some condition. Right now it is the same provision, that when you receive some amount, if you are not availing the if you are not allowed the exemption under section 10(10)(d), then what happens? I'm skipping this third line. Then what happens? Any profit or gain arising from the receipt of such amount by such person shall be chargeable to tax under the head capital gain, and shall be deemed to be the income of such person in the year in which such amount was received. That's it. So now onwards, from now onwards, what is happening with effect from assessment year 21-22? What is happening? Whenever any person receives any amount from unit linked insurance policies, if that amount is not exempt under section 10 clause 10(d), then that amount has to be, the profit or gain on that amount received has to be computed as per the provisions of section 45(1)(b), and it will be taxable in the year in which that person has received the amount. And the way of calculation is what the act will say. The income taxable shall be calculated in such manner as may be prescribed. Now it has become a little bit technical, but let me simplify some conditions for you, because I don't want to show you for the timing 10 clause 10(d), and I don't want to show you the calculation which are written, but I want to tell you only that much portion which is relevant for you to learn for the purpose of your examination also. So you should write these points which I will tell you. For 10 close 10b, you might not get it in different books, though in my book I have written this 45 1b, but might be in other books you might not find this section written. You might not find. I don't know whether you will find or not, but you might not find because it is a new section and relevant also for our semester 3. So I'm discussing 45 1b. So what conditions? You should note these conditions. Let me simplify those conditions for you. Amount under a ULIP has been received. Has been received. Second point.
So you're not
Excuse me, sir.
sharing your screen.
Not sharing. Okay. That's good. So the moment you think I'm writing something and screen is not visible, you should inform me. Is it visible now?
Yes, sir.
Okay, right. Amount under a ULIP has been received. Second point, this ULIP, this policy has been issued since the budget was presented on 1st Feb 2021, so the provision was made applicable from 1st Feb 2021. Making the provision retrospectively doesn't leave a good impression. That is why, if you remember, if you have seen the news, in Vodafone case, etc., there are some cases where some retrospective amendments were made by the government, but the Vodafone, that company, or other corporates, 3 or 4 such examples are there, where they have won the case in International Court of Justice, ICJ, and a different word forum. And that is why that retrospective implementation of one provision that was in residential status section 9, recently around 1 or 2 months ago, the government has revised that no retrospective tax demand would be made, and if it has been made under that respective section, then that will be reversed, because retrospective implementation leaves bad impression on the investors at any level. So if this provision came on 1st Feb 2021, government wanted to make it applicable with effect from 1st Feb 2021, so that if others don't want to pay the tax, they should not invest in such schemes. So this ULIP must have been issued on or after 1st Feb 2021, and also not only this, and the amount of premium payable on such ULIP exceeds 2,50,000 during any financial year. If till today you are investing in ULIP where the premium payable is not exceeding 2,50,000, when you receive the amount, there is no need to compute income under the head capital gain. Still, it is not for everyone. Still, it is for the people who are rich enough to pay a premium of 2,50,000 per year during any previous year. If you are still investing in ULIP but not paying the premium of more than 2,50,000, still you can claim so there is no need for you to compute when you the income under that capital gain when you receive the amount from this ULIP, when it will be surrendered by you or when it becomes matured. Because in that case, when you receive the amount, section 10 clause 10D, 10D, it is 10D. I think I have written 10B. 10D, yeah, but I think I have written 10B. Yes, I wrote 10B, it was 10D. It is not 10B, it was 10D. Now what I was saying is, if today I am investing in ULIP where the premium payable is not exceeding 2,50,000 per year, after 5 years, for example, I will receive back my money. There is no need for me to compute income under that capital gain when I will receive the amount. And what I received, if it is not computed under that capital gain, then there might be arising another question that under which head it will be taxable. If something is not taxable under one head, it does not mean it is tax free. Then you have to search for other heads. That amount which I received will not be taxable even in other heads if it is covered under the exemption of section 10 clause 10D, and 10 clause 10D covers most of the exemptions related to life insurance policies. I hope the point is a little bit clear. That today if I am investing in ULIP where the premium payable if exceeds 2,50,000 and if this ULIP has been issued on or after 1st Feb 2021 and if the amount is not given at the time of death, still today even if the premium exceeds 2,50,000 but if it is given at the time of death, no need to compute income under the head capital gains. The amount is not received at the time of death. If it is received at the time of death, no need to apply 45(1)(b). If it is not received at the time of death and if other first two conditions are also satisfied, so by looking at this provision, you can say that government is not willing to tax the capital gain. Government still wants that you please continue claiming exemptions under section 1010D. But in exceptional cases only, there was a need which has arisen to incorporate a new section 45 clause 1B just to catch those people who are very rich. Government thinks that those people don't deserve to have any exemption from it. The amount is not received at the time of death. If this is the condition, if above conditions are satisfied, then income has to be computed under the head capital gains and it will be taxable in which year? It will be taxable in the year in which you receive the amount. Amount is received. These three sections you are supposed to do. These are charging sections, founding sections, chargeability. 45 subsection 1 is the main, 45(1)(a) is special and 45(1)(b) is also special. If the charging section is clear or if the theory of capital gain is clear, please raise your hands. Very good. Now, if you remember, everywhere I'm using the word capital asset, capital asset, capital asset. So let us discuss capital asset. Now, second heading of this chapter. What is this capital asset? What do you mean by this capital asset? So for this, we need to go section 2, clause 14. Section 2, clause 14, it defines capital asset. So I need to show you the act. Section 2, clause 14. You must be knowing that all definitions are given. Either first preference is check that relevant section itself. If that section doesn't talk about, then check section 2 of the act. If section 2 also doesn't talk about, check other sections of the act. If that also doesn't talk about any definition, then you search for other acts. But first, within the same head, check relevant section, then section 2, and then other sections of the act. So since nothing is written in section 45 about what is kept lesser, I have no option but to go to section 2. Let us go to section 2, definitions, and directly go to section 2, clause 14. Search clause 14. This is capital asset. Capital asset means, subclause A, property of any kind held by an assessee, whether or not connected with his business or profession, doesn't matter. Every property in this world, all the properties are capital asset as per the definition of the Income Tax Act. Any kind, doesn't matter. And this is written in italics, as you have understood, that any unit linked insurance policy to which exemption under clause 10D of section 10 does not apply, etc. This was just to cover section 45(1)(b). Since they introduced 45(1)(b), there was a need to make this amendment also, that such policies are also treated as capital assets. That is not relevant for you. For the timing, you should learn that everything in this world is a capital asset. What is not a capital asset, that is relevant. So I'm not going to discuss with you what is a capital asset. I will discuss with you what is not a capital asset. What does not include. So what is not a capital asset? Any stock in trade, but other than securities referred to in clause B, ignore it. Ignore it. Just remember, any stock in trade or consumable store or raw material held for the purpose of business and profession, and it is logical also. Whenever anything is your stock for the purpose of business, then it is not a capital asset, because when you sell that stock, you compute the income under the head PGBP, not under capital gain. So by default, it is logical also that any item which is your stock for the purpose of business is not a capital asset. Second thing, personal movable property. All your personal movable items are not capital assets. Like if you sell your personal shoes at some profit, it is not a capital asset. No need to compute capital gain. You are selling personal car. You are selling personal car at a profit. It's not a capital asset. No need to compute capital gain. You are selling personal wristwatch at a profit. It is not a capital asset. You are selling personal house. That is a capital asset. That needs to be computed as per the provisions of capital gain, because that is immovable. So what is not a capital asset? Personal movable items, but excludes. But there are very few personal items which might be movable, but these are still capital assets. If you sell these personal movable items, you have to pay tax as per the provisions of capital gain. Jewelry is the example. Drawing, paintings, etc. Jewelry, drawing, paintings, though movable, even if personal, and if you sell these, you have to compute income under the head capital gains. So what is not a capital asset? All personal belonging which are movable except jewelry, painting, drawing are not capital assets. Any item which is your stock in trade which you are using for business and profession is not a capital asset. Third thing, agricultural land in India is not a capital asset. All agricultural lands in India are not capital asset, but some agricultural land in India are capital asset, very few. Just like personal movable items, all personal movable items are not capital assets except jewelry. Same here, all agricultural lands in India are not capital asset except those which I will explain. What I will explain is this part. In any area, any land which is situated in any area within the distance measured aerially, not being more than 2 kilometers from the local limits of municipality, etc. It is little bit, let me simplify it. I will simplify it when I will note it down on my screen. I'm moving forward. All agricultural lands in India are not capital asset except some, which might be agricultural, but still those will be capital assets. These bonds, 6% gold bonds 1977, 7% gold bonds 1980, National Defense Gold bonds 19 issued by the central government. So many times government issues gold bonds to reduce the importance of gold, to reduce specifically the import of gold. Most of the gold in India lies in the bank lockers or maybe at our home. So many people are having gold, especially ladies have the tendency in India to have gold, heavy amount of gold. But that amount which you invest in gold, that is not in circulation, so that is not used for the economy. That is of no use. Someone might be happy that that person is having gold, but till it is in circulation for the economy, for the nation as a whole, it is of no use. It is redundant. It might be an asset for an individual at micro level, but at investment at macro level, it is of no use. We pay a huge amount when we import gold. So our foreign exchange balance fluctuates because we need to pay the exchange or the money in the foreign currency when we import gold. So many times what happens is government brings out some schemes just like bonds where you can purchase gold bonds. You don't actually get gold. You purchase some bond, just one piece of paper. Just like you are having gold in your bank lockers, you can keep that piece of paper also in bank lockers. Because just like you do not use your actual gold, you will not use this paper also. So this is not actual gold, but these are gold bonds having the same value as that of gold, same value as that of jewelry. And if you need gold, you can surrender these bonds and you can encash these bonds in the form of gold. But since in India, most of the people who invest in gold, they keep it only in their bank lockers. So such things which are gold bonds, they reduce import of gold because people who want to have gold, they can purchase these bonds. Like right now, currently the scheme which is going on is sovereign gold scheme. There is a scheme, sovereign gold scheme, which is coming for the past 4 to 5 years on half yearly basis, where you can invest the amount in those gold bonds. You will get a certificate online on mail ID. You simply save it. That is your bond. That is your gold bond. After some years, you can encash those gold bonds. The benefit of these bonds are that when you sell these, no need to pay capital gain. So how do you motivate people to purchase bonds who want to purchase gold? How do you motivate them to purchase bonds? They know that when they will sell this bond, they will not pay any, there is no need to compute any capital gain. That is why this gold bonds, etc., are not capital assets, because had they been in capital assets, their sale, on their sale, income would be computed under that capital gain. The government excluded this in the definition of gold bonds from the definition of capital assets. So when you purchase gold bonds rather than gold, what benefit government is having? Our import on gold reduces, our foreign exchange reserves rises. People also get motivation. When they sell these bonds, they will not pay any capital gain tax. Interest also which they are getting, it might be also tax free. So this motivates people to come forward. So these are not capital assets. This is what my main purpose was. Similarly, for different purpose, special bonds comes. Special bearer bonds, gold deposit bonds under 1999. This government brought gold monetization scheme, etc. So the purpose is, main purpose is what I have told you, that rather than gold you purchase bonds, and when you sell this, there will be no tax under the capital gain because these are not capital assets. Other than this, everything in this world is a capital asset. So let me now briefly write for you what is exactly a capital asset. Such questions are theoretically relevant also. So I can say everything is capital asset. every property is a capital asset except the following. Except what? Stock in trade. Anything which is used and stock in trade is not a capital asset. Personal movable belongings except jewelry. Jewelry might be personal, but still that is a capital asset. If you sell your personal jewelry, you have to pay. You have to compute income under that capital gains. Jewelry, drawings, painting. Agricultural land in India is not a capital asset, except or you can say provided it is not situated. Provided it is not situated where? In a point or first point in any area under the jurisdiction now different regions have municipalities also municipal board like Delhi. In Delhi we have municipal corporation of Delhi. It's a municipality. Chennai, Bangalore, Hyderabad, these big cities are having municipalities. In villages you normally don't find municipalities. In municipal corporations the work system is little bit different. Birth registration, death registration, crematorium, etc., etc. These comes under the purview of municipalities, local authorities like if in Delhi you have agricultural land, it is a capital asset. If in village you have a agricultural land, it is not a capital asset. You sell the agricultural land in a village in India, you are not supposed to compute any capital gain. You sell the agricultural land in Delhi, you have to compute capital gain. So any agricultural land in India is not a capital asset, but if it is situated in those areas which I will tell, it will become capital asset, you have to compute capital gain. In any area under the jurisdiction of a municipality, in any area under the jurisdiction of a municipality or within 2 kilometers having population of, so roughly I am writing it, not the correct language, having population of 10,000 or more. Population of 10,000 or more, but less than 1 lakh. So if your agricultural land is in any area which is within the municipality whose population is 10,000 or more but less than 1 lakh, that agricultural land is not a capital asset. And in fact, not only in that area, but suppose if this is the area of a municipality and the area's population is 90,000, any agricultural land here, if you sell it, it is a capital asset, or even within 2 kilometers. So even within beyond 2 kilometers, if within 2 kilometers outside that area also within 2 kilometers, then all agricultural lands within this area also are treated as capital assets. These are capital assets, otherwise no other agricultural land. Similarly, any area under the jurisdiction of a municipality or within 8 kilometers, not within it, or within 6 kilometers, having population of 1 lakh or more but less than 10 lakh. that is also not to be treated as, that will be treated as agricultural. Like if for example population of any city, like I think Noida example you can take, or you can take any example. I don't remember exactly the population of the city as per 2011 census of Noida. If the population is till 10 lakh, it is of course beyond 1 lakh, but if it is still 10 lakh, all agricultural lands in Noida are not, are to be treated as capital assets, are to be treated as capital asset, and even till 6 kilometers, even outside, if within 6 kilometers, still those are also to be treated as capital assets. If you sell agricultural land here, then you have to compute income under that capital gains. Last point, here itself I will write, any area under the jurisdiction of municipality or within 8 kilometers having a population exceeding 10 lakh. Like if in Delhi, Delhi's municipal population is more than 10 lakh. Within Delhi, all agricultural land are capital assets. Not only even within Delhi, but if this is the Delhi, then beyond 8 kilometers of Delhi, all agricultural lands are also capital asset. Here, if you have any agricultural land, it is not a capital asset. So you can say most of the agricultural lands in India are not capital assets except these areas, because technically if you have municipality, municipal corporations doesn't exist in villages. So if you have a municipality, that is not a rural area, that by default is an urban area where proper system and structure are there. In Delhi you might find, in Delhi the roads which are so much systematic, etc., etc., you will not find these roads in villages because of lack of municipality. So municipal corporations are mostly in those areas which are towns or uh, big towns, you can say big cities. So this is what you should remember. Fourth point, what is not a capital asset? Different gold bonds, you can refer those. Different gold bonds, you have to write the names. Okay, don't use the word different, I'm using it because I have shown the, otherwise you learn those different gold bonds. These all are not capital assets. When you sell these, there is no need to compute income under their capital gain. Otherwise, all other items which you sell are treated as capital assets. Please raise your hand if capital asset concept has been clear. Then I'll discuss with you other points. If capital asset is clear, we are still not at the numerical portion because theory must be strong. If theory is strong, then easily I can attempt the numericals. Next point, if you remember now in section 45 subsection 1, I was discussing this word capital asset and transfer word is used as so many times. What do you mean by transfer? You must know what is exactly this transfer. Let me show you section 2 clause 47. So this is my third point. What is exactly this transfer? What is exactly this transfer? So today theoretical structure of capital gain will be clear. You must find time to revise income tax. It will be very lengthy very soon. So read all the previous chapters which I have covered and read daily go through these uploaded lectures. If you are because of some reason couldn't attend this, at least see those on daily basis. You have to see what is the meaning of this term transfer. Now it might look very simple to me, transfer means sales, but when you read the act, you must first read the language. 2 clause 47 or 45, I think, no 47, 2 clause 47. Let me show you the act. Section 2 clause 47 defines What is exactly this transfer? Seven. 2 clause 47. As you can see, the definition of section 2 clause 47, transfer in relation to a capital asset includes, it is inclusive definition. Still you cannot say that only these things are transfer. The word used is includes. Other than these also, which are given below, other thing can also be treated as transfer depending upon case to case basis. But almost everything will be covered here. Sale, every sale is a transfer. Exchange, just because I exchanged my house with my friend for his Mercedes, it does not mean that I have not transferred the house, or it does not mean that my friend has not transferred his Mercedes. I transferred my jewelry. I exchanged my jewelry from my friend's house. My friend has given me the house, I have given jewelry. You cannot say that we have not transferred it, we only exchanged it. No, Act says every sale is transferred, exchange is transferred. If you have dismantled or discarded your asset, still that is transferred. Compulsory acquisition, if government has acquired your land compulsorily, forcefully, because of, for example, Delhi Metro, it is transferred. That's it. Detail I'm not discussing. So one thing is sure, that what is transfer? Not only sale, not only the sale is transferred. You must remember that every sale, exchange, relinquishment, compulsory acquisition, all these things of any capital asset are treated as transfer. So one thing is sure, that as I remember now, my discussion will be on section 45(1), because I told you 45(1)(a) and 1(b) are special. So I am not discussing any example for the timing of 45(1)(a) and 1(b). By default, when you are listening to what I am saying, you must be having only one picture in your mind, that in the mind of mine, section 45(1) is going on. And if I remember the conditions of 45(1), what are the main conditions? There must be a transfer and the asset must be capital asset. For the time being, these two are main thing in section 45(1), that there must be a capital asset, that I have told you, and there must be something which is transferred, that also I have told you. But related to the transfer, one new concept is also necessary for you to learn. There are some transactions which might be a sale, there are some transactions which might be sale but still not transfer. This is a new point. So there are some transactions in which sale will happen, in which exchange will happen. Sale will happen, exchange will happen, but still you say that this is not transfer. And if it is not transfer, there is no need to compute capital gain, because when something is not a capital asset, when something is not transfer, I will not compute income under the head capital gain. So now my fourth subheading, transactions which are not treated as transfer. Transactions which are not treated as transfer. For this we have separate sections, section 47 given under the head capital gain. So everything is linked now. Section 2 is linked with sections of capital gain chapter. Transfer. Meaning of transfer is mentioned in section 2 clause 47, and coincidentally 47 is section number also, which tells you the transactions in which sale will happen, exchange will happen, but Act says Don't treat it as transfer, and if you don't treat it as transfer, no need to pay any capital gain tax. Section 47. First of all, to check whether something is transferred or not, this 247 is very easy. That every sale exchange is transferred, but I need to check section 47 always whether my transaction is covered under this section 47 or not, because if it is covered in section 47, then it will not be treated as transfer, and if it is not treated as transfer, I will not pay any capital gain tax. Now around 25 to 26 transactions are there, but in your course you are not supposed to learn all those. I will tell you those which you have to learn. Around 9 or 10 you must learn. You must learn around 9 to 10 of section 47 transactions. I will write these for you now, but in reality you are having 25 to 26 such transactions which are not treated as transfer. Let me show you the act now. Section 47. Just let us go and type here. (47). I hope this screen is visible. Hurry up. Is the screen visible?
Yes, sir.
Okay.
Yes, sir.
Transactions not regarded as transfer. Click section 47. As you can see, nothing contained in section 45 shall apply to the following transfer. It is covering not only 45(1) but all special subsections of 45 also. That whatever is mentioned in 45, in every subsection of 45, all these transactions will not be treated as transfer, and if you don't treat anything as transfer, you are not going to compute income under the head capital gains. These are these points: clause 1, clause 2, clause 3, and I told you there are so many of these clauses. Starting from 1 to clause 19. Within 19 you are having different also: 10A, 10B, etc. 7A, 7AF, AE, 7 ACAD, etc. So I will write now this for you. The purpose was to show you that, just like a very simple example, not example, very simple clause 47, clause 3, very simple, and it's very easy to understand also. Any transfer of a capital asset under a gift, that's it. Only learn it or only remember it. When you give anything as gift to anyone, you are not going to pay any tax because that is not treated as transfer. That's it. It's very simple. I am paying a gift of my house to my friend. I will not say that it is transfer. Though I have given it to my though I have given it to my friend, I will not compute any capital gain. Government will not say that it is a sale. As a gift, if you transfer any capital asset, you are beyond the purview of capital gain. Whenever holding company transfers assets to the subsidiary companies, no need for the transferor who will earn the income, is supposed to pay any tax on capital gain. Whenever subsidiary company transfers anything to the holding company, then there is no need to compute income under the capital gain. In a scheme of amalgamation, when an amalgamating company transfers assets to the amalgamated company, no need to compute capital gain tax. In fact, no need to compute income under the capital gains. So I have given you some idea about the transactions which are not treated as transfer. Now you have to read this act yourself, and I will tell you only those clauses which you have to read. So note down this. This is for self-study because The purpose of this lecture is not only to teach, not to teach you each and everything, but to give you idea also how to make you you can say perfect in reading the act also. And this perfection comes only when you read yourself. If I'll start reading everything for you, then you never learn anything. So you have to read also so many points. So within section 47 now, you have to write something. So I'm still continuing with fourth point. Transactions which are not treated as transfer. Section 47. So which transactions you have to learn? So very small language I will use also, but you have to read it yourself. Distribution of assets at the time of partition of HUF. Distribution of assets. If I'm writing assets, by default you must understand that I'm writing capital assets. Distribution of capital assets at the time of partition of HUF. 47 clause 1. Second point what you should do, transfer of capital assets by will or gift. Transfer of capital assets by way of gift. That is very relevant for your level or will. We will use it at so many places. 47.3. Transfer of asset by a holding company. Transfer of capital assets by a holding company to an Indian subsidiary company. To an Indian subsidiary company. 47.4. Similarly, in theory such questions can come that name any 7 transactions which are not treated as transfer. Then you have to remember at least 7 to 8. Transfer of capital assets by a subsidiary company to an Indian holding company. Transferor is that who is transferring. Transferee is that who is taking. Okay, transferor and transferring. Transferor is who is giving. Transferee who is taking to an Indian holding company. 47.5. Next point which you should remember is only these you should remember, other please don't do. Transfer of capital assets by the amalgamating company to an Indian amalgamated company. Amalgamating is the transferor which is going to be merged. Amalgamated, in which this company will be merged. Amalgamating company to an Indian amalgamated company. 47.6. Then you do transfer of capital assets by the demerged company. I don't know whether you know demerger or not. If not, do something on Google. Demerged company, when only portion of the company will be removed from the existing company and this separate portion will be given a new entity, a new company. Demerged company to an Indian resulting company. to a resulting Indian company. Or Indian resulting company. The company new must be an Indian company. 47 clause 6b. Then you do only relevant ones you have to do. Transfer of sovereign gold bonds. Transfer of sovereign gold bonds 2015 issued by RBI. This scheme started in 2015, issued by RBI. When you sell these, you don't need to pay any capital gain tax because you can compute. There is no need to compute, in fact, the income. 47 clause 7. So you are not supposed to learn these sections. Don't learn it. This is only for you if you want to read the act. Otherwise, please don't learn it. Main section 47 you can remember, but don't remember these sections. Conversion of bonds into debentures. 7th, and this is 8th number. Conversion of bonds into debentures. So government will not say that when you converted conversion of debentures into shares, when you converted debentures into shares, government will not say that debentures have been transferred. No, government says under 47 it is no transfer. Conversion of debentures into shares is not treated as transfer. Conversion of preference shares into equity is not treated as transfer. That's it. These 9 you learn for your level. These 9 you learn for your level. These are those transactions which might be within the definition of section 2 clause 47 that these are transfer. But section 47 is supreme, which says that these transactions will not be treated as transfer for the purpose of computing income under the head capital gains. And I think we should end the discussion now. That's all from my side. I think we should end the discussion now. Next concept which I will start is kinds of capital assets. Let me note it down for you. Or please raise your hands if you want to cover remaining concept today's also. Please raise your hands if you think that I should proceed. I want to end the discussion because I think that we have covered a lot, but still if you are comfortable, please raise your hands if you think that I should go on for next half an hour. If you're comfortable, please raise your hands, or you please raise your hands if you think that I should end the discussion now. Please raise your hands if you think I should end the discussion now. Okay, so most of you are willing to end the discussion now, and that I also wanted, but very soon I will start discussing with you the next portion. I will inform. Tomorrow is off day, but most probably tomorrow I will not find the time. So either today evening or tomorrow evening I will try to manage. I will inform you through WhatsApp. That's all from my side. Goodbye. Please revise it. You have to revise text now on daily basis because my speed will be a little bit high to cover the course. So please make a revision of income tax now on daily basis. You cannot afford to skip now without reading daily income tax. That's all from my side. Goodbye.